Welcome back to the Daily Nugget, daily property insights, one topic, 20 minutes or less. Myself, Lawrence Lotze, and today joined by Andrew Armstrong, a mortgage specialist. And Andrew, the question to you today is, with the market being the way it is, high interest rates, month on month, we're going a little bit backwards on the price of houses at the moment. What is sort of the strategies for investors at the moment that could play out in the next couple of months, or sort of longer term, 6 to 12 months, that you see that could be in play at the moment for the property market?
Yeah, we're seeing a lot of people out there, or probably not seeing enough people giving us a yell. We want to talk to as many people as we can regarding what's on the horizon for property interest rates and your options going forward this over the next 12, 24 months. A lot of people are coming off really low interest rates, starting with a 2 in front of it, and they're ending up on something with a 5 in front of it, and it's very daunting. And more often than not, some approaches are, well, stick my head in the sand and hope for the best at the time that it comes up. We're encouraging people to get in touch with their mortgage advisor and discussing options going forward. Now, some of the options might look at, hey, is there an opportunity for me to convert some of my investment loans, for example, onto interest only to protect a bit of cash flow and build up a bit of a buffer to cover any unexpected expenses or additional costs, etc. The other one is you may see that investors have been aggressively repaying all loans down over time.
Mm-hmm.
So that's where you might have had a 30-year loan term, but you're on track to pay it off within 20 years. Again, if the interest rates go up and you're worried about making payments or missing payments, then a strategy has been to extend the loan term again until a little bit more stability or income increases on those properties, or the perhaps you get a lower interest rate after a next 1 or 2 year fix, however you go for. If you don't have that long left, in other words, you might be 15 years off, documented over 15 years, you are locked into having to repay it over 15 years, but you're concerned about cash flow or not able to, meet it because something's happened, then we can always look at a restructure within your existing bank, which is essentially restructuring from 15 years back over to 30 years to reduce your minimum repayments. And failing that, if your existing bank isn't willing to entertain that, refinancing to another bank. Obviously, all of these processes are subject to your normal bank credit criteria and affordability, and all of that.
I'm guessing one of the biggest questions you might get at the moment, Andrew, is do I break? Do I break and refix and get myself, some of the jumps? I'm going to be one of those people that's going to be doing that big jump. I still have 1 or 2 mortgages that start with a 2 right now. Luckily enough that I've got them till into next year, so it's not hitting me as soon as yet, and hopefully some of those rates might have turned by then. But I'm guessing that's a big question that people are saying to you is like, should I break at my 2% and try and grab a 4, high 4 before it gets to that 5 or 6, that glass ball type question, which I know as a broker you would get every single day. I can imagine a lot of people are calling you up and going, where's the way to go with this?
Yeah, it is. It's certainly in a daily conversation rotation at the moment. And it's a really hard one to pick because we still don't know where interest rates are going to be at the end of that term that you're coming off. Yeah. So it's really a bit of a punt or roll of the dice. But what we do is we discuss, hey, if you break and refix now, are there any costs? Typically not, because you're going from low to high. And it may be a small admin fee from your bank, depending on who you're with. But you're doing that on the basis that you think that the current 1 to 5 year rate is going to be lower than what it will be at the time of your renewal. So that might be, a year out, it might be 3 months out. Typically, we're having these conversations around 3 or 4 months out, but some people go, well, I'm constantly refixing at 2 and 3 year terms, and I'm worried. In short, we go and go, well, how much interest will you have saved by keeping on the current rate versus the new rate? So we'll compare that, and then you go, well, what if interest rates are a certain amount, what's the benefit between the new rate that you're locking in versus what it could be in 6 months' time or 3 months' time? It's a reasonably hard one to pick or advise on, because there's no necessarily right or wrong answer, because I don't, no one knows what's happening in the future. But there are ways that you can sort of become a bit more comfortable with your decision.
Are you seeing at the moment at the banks that they not? I don't want to say the word more lenient. I know banks work within a set framework, but are you seeing them being a bit more willing to listen and look at options around for people? Because imagine the biggest thing banks do is they want to make money, but they also don't want to have that money they're making be defaulted by the end user or the owner and so forth. Because I can imagine someone coming off and buying during COVID a $1.5 million property at 2% and now coming on to a 5%. That 3% jump on 1.5 million is 45 grand a year. You're talking about an additional $1,000 a week almost. And going to the bank, are they willing to go, hey, there could be options here or that, or are they still being real strict on what you can and can't really do?
Yeah, well, I mean, it's a hot topic. You would have seen it out there. Some of this triple CFA discussion, credit contracts, Consumer Finance Act amendments. It's not that the act has necessarily been, suddenly introduced. It's just been changed and it's more specific. It removes a lot of the ability of a bank to make those recommendations of all those suggestions as to what you can or cannot do. That they, in the past, bankers might have gone, yeah, you do this, do that, this will work, we'll give it a crack. They certainly were not, they shut up doing any sort of form there for a wee while. Now it has come back, it has been amended, that's been in sort of local media, but you won't find a bank sort of making a lot of recommendations in that space because they just simply aren't necessarily set up to do that. And that's where talking with an advisor is going to help you. But to answer your question in a slightly different way, a bank should be there to help you. They're not going to not help you, but they probably are more likely to require instruction from you as to what it is that you want them to do, rather than what they're suggesting you could do within their sort of policies.
Awesome, thanks, Andrew. And one last question. Obviously we're talking about there's different strategies, looking about it, reviewing, breaking if need be. Is there anything else that anyone that has a mortgage at the moment, anyone that is either a first-time owner or even in the investors, that should consider, think about, plan about? Is there something that people need to be more proactive about in the current market that might protect them 3 or 6 months down the line if they've been proactive right now?
Yeah, it's just knowing what you're in for and getting prepared. So, as I say, you don't stick your head in the sand. Get in touch with your advisor well in advance and go, hey, what options are available for me? Do I extend my loan term to reduce my minimum repayments? Do I sell a property? Do I refinance to another lender because my existing bank simply won't help? Do I refinance and actually add an interest-only period on top of that, and then double down on the principal repayments on my personal house as an investor? I've got all this equity, maybe a low debt, I can afford the existing loans on the current house. Do you look into those options, or you simply release a property to de-risk yourself? There are all sorts of ways that you can look at your situation without necessarily going, hey, how do I borrow more? It's, hey, how do I maintain what I have and still pay off debt and reduce my overall risk exposure in any given event? But all I can say is do it in advance. Don't wait until it's on top of you, because at that stage it's possibly a bit late, and you may be having different conversations with your bank at that stage or your advisor.
Awesome. Thanks for that, Andrew. And as always, everyone else that's having a listen or watch, thanks for coming over to the Daily Nugget, Daily Property Insight. One topic, 20 minutes or less. And as always, hope to see you tomorrow.